Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent FOMC and, of course, how it relates to risk assets like Bitcoin. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. We had a pretty interesting meeting today with the FOMC. The Fed did, in fact, cut rates from 4.75% to 4.5%. So they cut 25 basis points. You can see it here on the chart. Interest rates have dropped from terminal rate this cycle of 5.5%. Now this marks 100 basis points of rate cuts ever since the rate cutting cycle began back in September. But that's not the only thing that we should talk about, because while they did continue to cut rates, they've also decided to continue quantitative tightening. And you can see that here where it says the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. So there's this idea that at some point the Fed will begin to expand their balance sheet again, but that has not yet happened. So if you were to actually just look at total assets held by the Federal Reserve, you can see it's mostly just been on a downtrend really since early 2022. And last cycle, you can see that they went through a period of quantitative tightening as well, but it didn't last nearly as long as this cycle's quantitative tightening. And the reason that, of course, we mention that is because we know, and again, history doesn't have to repeat itself, and there's a chance that dominance has topped, but we do know that last cycle, dominance did not actually top until QE began. And even then, it did sweep the high over a year later. So it's at least something to consider as we continue to navigate the cryptoverse, try to figure out what is the most likely outcome. To remember that it wasn't until QE began that Bitcoin dominance really started to durably go down, and that could partially explain some of the resilience by Bitcoin dominance recently. It's continued to move back up. But the thing that I think you should also remember is that there was an almost identical move last cycle by dominance, where it dropped in November of the halving year, which is exactly what it did this time, and then it went back up in December of the halving year, and even continued to go up until January of the post-halving year. So there's always a narrative to accompany everything, but you could also argue that narrative follows price. Price does not follow narrative. So same thing's happening this cycle as far as dominance is concerned so far that happened last cycle. We'll see what dominance does, but still currently at 58%. So when thinking about, monetary policy and how it affects the markets, it's also important to look at what's likely going to happen next year, or why are the markets reacting in a certain way. Obviously, the markets have sold off quite a bit here. Bitcoin's back down to 100K. The S&P has even dropped almost 3% today, which is actually quite a big drop for the S&P to drop in a single day. We don't get it that often where you see a 3% drop in a single day, and you can see it dropped almost 3%, 2.95%. So rather steep drop back down to, I suppose, this support level here. So we'll see if that holds. But one of the reasons that drop could have occurred, if you're looking for a narrative to blame, is if you go over and look at the summary of economic projections, you will see that most market participants are thinking that the Fed's only going to cut twice next year, right? And there's some market participants that think they won't even cut that amount, and then there's a few that think they'll cut more than that. But sort of the median number of cuts expected for next year appears to only be 2, which would get interest rates back down to 4%. Now, this is potentially less than what markets were hoping for, and that might be some of the perceived weakness. Some of the things that Powell said today, I'll just read off a few quotes so you can kind of understand his mindset and where he's coming from. He says the economy is strong overall, but he did say that a broad set of indicators suggest that conditions in the labor market are less tight than in 2019. And we've obviously made a lot of comparisons to 2019. That was when we had the last rate cutting cycle. And he did say that downside risks to the labor market has diminished, but he went on to say that job creation is now well below the level that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. He still believes that policy is meaningfully restrictive, which essentially means that he thinks that interest rates, right, as they stand right now, he thinks that interest rates are currently still above R star, the neutral rate. Now, if you're not aware what the neutral rate is, it's this theoretical concept. It's like sort of an abstract idea that suggests there exists an interest rate at when interest rates are at, or if it's below that level, the economy should expand. If interest rates are above that level, the economy should contract. And it's probably a little bit more nuanced than that. Not everything is based solely on interest rates, but if you do buy into that idea, Powell is essentially saying that 4.5% for interest rates is actually still above the neutral rate. Therefore, it should still help slow the economy down. Now, what he's referring to when he says that job creation is well below the prior, the pre-pandemic levels, and that people are having a hard time finding a job, what he's referring to are all these charts we've been going over here on, we've been going over on ITC for quite a long time, right? Hires are down, and hires have been trending down. Quits have been trending down. So, that stuff has been in a pretty long downtrend. If you look at the unemployment rate, it's still relatively low, right? And one of the reasons I think it's relatively low is if you go look at reasons for unemployment, the reasons for unemployment for job losers has been in a fairly controlled uptrend, right? It doesn't look parabolic. The angle of attack isn't the same as what we saw during prior recessions. One of the main reasons the unemployment rate has gone up is just new entrants to the labor force, right? That arguably has been going parabolic, suggesting that it's actually quite difficult for people to find a job if they don't currently have one. But because layoffs are still low, if you have a job, there's a good chance you've been able to keep it. Now, obviously, that doesn't apply to everyone, and you don't want to be insensitive about that sort of stuff. But layoffs, if you look at them, right, if we just look at them objectively, go over to layoffs and discharges, they've actually been relatively low, and on average, they've been lower than where they were pre-pandemic. So you could argue that the markets have still done relatively well despite a slowly increasing unemployment rate, because the main reason the unemployment rate's going up potentially is just due to an expanding labor force rather than layoffs. Now, where it could theoretically become a problem is if you do get layoffs, right? Because if you get layoffs and people aren't hiring, that's what leads to the acceleration of the unemployment rate, right? So if the unemployment rate's already going up and layoffs are low, if layoffs start to pick up and hiring is low, that's how you see the unemployment rate go up a lot quicker, and that's what can lead to sort of panic in the markets, right? Those are when the recessions actually occur. So it's important to follow this stuff, even though it might be somewhat dry and boring to listen to. He did go on to say that, he said that we are at a point where it makes sense to slow the pace of rate cuts. He says there's no reason to think a downturn is any more likely than it usually is. And he also said, I think it's pretty clear that we've avoided a recession. I do find it somewhat interesting, not because he's wrong per se. I mean, obviously the markets, we haven't really seen a recession, despite a lot of people calling for it only a couple of years ago. But one of the things you have to remember is that, as he says, monetary policy operates with long and variable lags, right? So just because you haven't seen one yet doesn't mean you won't, right? You could have one still ahead. And we've actually seen some recessions occur right around the time that a new president takes office. In fact, we saw one in 1981 when Reagan, when Reagan began that term. if you go zoom in over here, you can see what I'm talking about, right? So here's December of 1980. The market kind of topped out for a little bit, went down for a little while, and then ultimately trended back up. But I mean, you can see what I'm talking about, right? So December 1980, and then you get into 1981. Market went down for a little while, and then started to go, to grow again. But it does go to show that you really can't discount anything, when it comes to when it comes to sort of the macro stuff. And I think the other thing hard with macro stuff is it takes so long to play out. By the time certain ideas do play out, most people have given up on those ideas. Now, what we try to do over here is we try to acknowledge these long-term ideas, but remind people that they will likely take years and years to play out. So while there's a good chance we do eventually get a recession, I don't really think it's, the overwhelming favorite of a scenario until you see initial claims come in at around 300,000, right? Right now they're at 242,000. As long as they're down here, it's still relatively low. Once you see them above 300K, that's probably when it becomes somewhat problematic. But we haven't seen that yet, right? We haven't seen that yet, and there's not, there's no telling exactly when that's going to happen. Of course, it makes sense to go look at treasury yield spreads because we are starting to see the uninversion of the yield curve, right? So it's interesting because there have been plenty of times in history where the uninversion of the yield curve did, precede a recession. But as I've said previously, while sometimes you had a recession within a month or two, other times the recession didn't occur for 6 to 12 months later. And in one case, in 1967, it didn't occur until 2 years later. So I find it interesting that Powell does say that, he says he thinks it's pretty clear that we've avoided one. I would agree that we have avoided one in 2023, and we've avoided one, it looks like, potentially in 2024. But, what will history remember this as? Will it just kind of look like this eventually, where you get one just as everyone's kind of given up on the idea? So at least something to keep in mind for 2025 and potentially 2026 as that yield curve uninverts. And remember, one of the things about yield curve uninversion is that sometimes it could uninvert and then reinvert, right? Just because you see the uninversion doesn't mean it's going to stay that way. To a large extent, it depends on, Fed policy. And one of the things that I've mentioned as well is the 10-year yield, right? If you go look at the 10-year yield, it's kind of had an interesting movement recently, and not one that we didn't anticipate. I said when the Fed starts cutting in September, we were likely going to see the dollar rally into the end of the year. And that's basically what's happened, right? The dollar was down at 100. Now it's at 108. I'm guessing it's going to rally into the end of the year, potentially find a top sometime early January is my best guess on the dollar. But the reason I say that is because the dollar and the long end of the yield curve have been fairly highly correlated for quite some time. And you can see that the long end of the yield curve, right, the 10-year yield, is now bouncing. Now, the reason why this is important is when you look at sort of what's happening here with the 10-year yield, depending on how you want to draw this, right? But you can kind of see that it might be repeating kind of what it did a little over a year ago, where it had sort of these tops and then it eventually broke out and then came back down to sort of retest where it broke out from. You can kind of see the same thing happening right here, where it then eventually broke out and then it went back down to sort of retest where it broke out from. Now, again, this is a little bit more of a dubious trend line. I'm not really sure it's the exact same thing, but you could argue that there's some similarities there. And remember, if the long end is breaking out here to go higher, then if you look at what happened last time that this happened, the S&P did at least go down for a few weeks before then continuing its overall trend back up. So do be aware that could happen. And also, furthermore, when you look at assets like TLT, oftentimes, not always, but oftentimes they do find sort of macro double bottoms. Okay, so if you look at like sort of the weekly for something like TLT, remember TLT is inversely correlated to the long end of the yield curve, right? So if the long end of the yield curve goes up, TLT goes down. And so I guess the argument is it possible for TLT to come back down here where it was in October of 2023? And it doesn't have to, right? But there is some precedent for TLT sort of finding a macro double bottom, or even sweeping that low before making another move back to the upside. So I would at least keep an eye on that. And you could have a double bottom just right here, but I wouldn't be that surprised if you saw it down here once again, especially with the Fed cutting. And it could be it could be a way of saying that it's not recessionary, right? The fact that the long end of the yield curve is going up. You could argue that the long end of the yield curve is doing what the Fed is unwilling to do, and that is to stay higher for longer. And I'm not saying they haven't stayed higher for longer at all, but this is very abnormal, right? The long end of the yield curve does not normally go up this much after the Fed starts cutting rates. And one potential explanation for the long end of the yield curve going up following rate cuts is that the market is starting to price back in inflationary concerns, right? So if you go look over here at inflation year over year, it has started to go up a little bit recently. I mean, it's not that concerning just yet, but remember, it started off slow in the 1970s as well. And then in the post-election year, right? So the post-halving year for us D-Jones, it started to really go up, and that's what led to a broader market correction. But one of the things that you should note is back then when inflation did start to go back up, it was when the unemployment rate started to go back down, right? So if you look at say here's the unemployment rate here, and if you overlay inflation, you'll notice that back in the 1970s, right, when unemployment started to go down, that was when inflation started to accelerate again. And the same thing later on in the 1970s, right? But now you're seeing kind of the opposite, where inflation's going down, but the unemployment rate is going up. Powell actually did address this. He said, and I quote, let me see if I can find it. He said the labor market is not a source of significant inflationary pressures. And I agree with him. I mean, the unemployment rate is trending up, not trending down. In the 1970s, the unemployment rate was trending down. And that led to, more waves of inflation. But you could argue that with the unemployment rate trending up, this would not be a significant portion of future inflation. Now, if you see the unemployment rate start to go down again, then the narrative might change. And it probably will at some point, but we haven't seen that yet, right? We've seen the unemployment rate go up. We've seen inflation come down. And now the question is, something's got to give, right? Either inflation needs to keep coming down to the 2% target, because if it doesn't, it just means the Fed's going to have to stay restrictive even longer, which is going to make which would likely make the labor market loosen up even more, sending the unemployment rate higher. So, certainly a lot of things to consider with what Powell's talking about. Again, with quantitative tightening continuing, it could explain why a lot of these altcoins are stuck in traffic on struggle street today. And it also could help explain why Bitcoin dominance is up. I've said many times that dominance was going to go to 60% this cycle, and it has. But that doesn't mean that it can't bounce around there, and it's always possible it goes higher. I would watch the bull market support band for Bitcoin dominance, because you can see it's trying to get back above it, and it is above it right now. Let's see if it gets a weekly close. I would also keep an eye on dominance excluding stablecoins, because it's been in this wedge for a very long time, and it actually looks like it's trying to break back into the wedge right now. So if it's able to get back in it, then that could certainly change the narrative on dominance in 2025. But there's also a good chance that it just gets rejected by the bull market support band and goes down in 2025. But in the short term, I think the reason why altcoins are struggling, especially on their Bitcoin pairs, is just simply because QT continues. And last cycle, alt Bitcoin pairs struggled until QT ended. Now, not only did they say that it's continuing, but they gave no clear insight as to when it's going to stop either, right? They just say that the committee will carefully assess incoming data, but that they're going to continue to reduce their holdings of Treasury securities and agency debt and agency mortgage-backed securities. So, it's interesting because, I think a lot of times the market participants want to really kind of front run the Fed, but then they do, and then the Fed has to stay restrictive for even longer because market participants keep trying to front run things. So it could just be a game of chicken, right, to figure out who's gonna fold first. But certainly interesting thing. And if you look at alt Bitcoin pairs, actually, this is kind of an interesting level for them because they actually also got a move to that exact same level a couple of times in the past, right? They got a move back to this level in June of 2019, and also they got a move to that same level in August of 2017. So we'll see what happens here. My guess is if they're gonna bounce, they won't bounce until the bull market support band, right? Which is back at say 0.4 to 0.41. Okay. So if they're gonna bounce, it's probably not till then. And there is still a non-negligible chance that they do eventually return to the range lows. I know it might not be the most likely outcome for a lot of people, but remember, even in October of the post-halving year in 2017, they were at the range lows. So they could eventually find themselves there once again, even though Bitcoin dominance did in fact go to 60% already. Now, obviously, Bitcoin took a hit today. In the grand scheme of things, I mean, this is what the weekly candles look like. So it's kind of hard to even notice, like, the correction. But if it does evolve into something more, just note there is some precedent for it. I mean, we saw something similar happen with some of the cryptocurrencies back in 2016 when the dollar rallied, the long end of the yield curve rallied. We also saw altcoins kind of struggle until the post halving year, right, until 2025. So this is what happens a lot of Decembers of halving years, right? Like everyone kind of gets a little excited from alts front running things in November, and then in December people think that alts are going to continue to run, and then they just kind of stall out and potentially not make the move that people want them to make until sometime in the post halving year. This would not be the first time this has happened. And it could just simply be due to things like the dollar continuing to go up, right? If the dollar goes up, Bitcoin dominance normally follows it. I mean, you can even overlay Bitcoin dominance and see what I'm talking about, right? Normally when the dollar starts to get these rallies, right, Bitcoin dominance can start to accelerate back up to the upside, and you're kind of seeing something like that potentially start to happen here as it's continuing to go up. Perhaps market participants can no longer ignore it, and exactly what happened in late 2016 could potentially happen again, where altcoins struggle and then they start to do well again after the dollar tops out. Now, remember, the dollar did not top out in 2016. I actually believe it was early 2017 when the dollar topped out. You can see there it topped out, basically the first week of January. So I'm arguing that the dollar is currently in this move right here, right? Sort of the last move that it's going to get for a while. And I'm thinking it might go up to 109, 110, something like that. It could go higher, but that's kind of what I'm thinking. If you look at a fib retracement on this, you can kind of see that it's topped out around the 0.5 fib a couple of times. Now it's moving higher. The 0.618 would put you at 109. The 786 would put you all the way up at 111, right? And remember, the prior high is all the way back up near 115. So we'll see what the dollar does, but my guess is it will remain strong until sometime early 2025. The other thing that'll be interesting to watch for, and I don't think they've made the decision just yet, will be the Bank of Japan, right? Because the Bank of Japan is likely going to keep rates constant. If they do raise rates, that would be probably a very negative outcome for risk assets, right? If they do raise rates. And the reason is because the carry trade would have to get unwound even more. And the carry trade essentially is just, looking at the difference between, or it's basically just people, going over there to get cheap money because it's easier to do so over there than to do so over here. And if the spread between interest rates in the United States and Japan narrows, then that carry trade gets unwound. And you can kind of see what I'm talking about, right? As you can see prior times where the difference between interest rates in the United States and Japan started to drop, it can sometimes lead to negative economic outcomes, as you can see the green shaded region. Now, I think people look at this and like, oh, well, it has to happen immediately. I mean, think about this. Ever since this has been dropping, Bitcoin essentially went from like 50K all the way up to 100K, right? So you might say, well, this is not worked this time. But this is one of those things where like it takes years to play out. I think a lot of people just lack sometimes the patience to see it play out. It doesn't mean you shouldn't be an investor. It doesn't mean that you shouldn't take risk or anything like that. It just means it's something you should be aware of that could eventually play out, and how do you want to navigate such an environment if it does play out the same way it has previously. So we are going to likely see the continued normalization of the yield curve as the short end continues to go down because the Fed's cutting and the long end continues to go up, right? So you can even see the yield curve is almost completely normalized from basically a completely inverted yield curve not that long ago, right? This is what the yield curve looked like about a year ago, and then now this is what it looks like today. So the yield curve is normalizing. It's starting to look a little bit healthier, and we'll see. We'll see what happens, I guess, in 2025, and we'll try to follow this stuff. Provide these outlook videos on the macro stuff about once or twice a month, right? When the inflation data and the macro data, the inflation data and the labor market data comes out, and also, whenever there is in fact an FOMC meeting. So that's where we are, guys. That's where we stand with the markets. Let's go check in on Bitcoin one last time. So right now it's at around 101K. So I mean, again, like if you think about it like this, if you look at it on a line chart, you wouldn't even know. You wouldn't even know anything has happened. Obviously, because it just went to 108, with it all the way back down to 101, that has people feeling some type of way about that. But I wouldn't be. I mean, I really wouldn't be that surprised to see dominance kind of hold on for the next few weeks. And maybe even go up a little bit more for the next few weeks. But sometime in 2025, I do anticipate all Bitcoin pairs going up. I think the concern, though, is, will they in fact have to wait until QE returns to go up? Because we just haven't seen that yet, right? We haven't seen QE return yet. Therefore, there's some level of justification that Bitcoin could still outperform the collective altcoin market, even if it doesn't seem like the most likely outcome at the current time. But anyways, guys, we're going to go and wrap it up there. I do appreciate you guys tuning in. Make sure you subscribe. Give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. See you guys next time. Bye.